The money in your bank account right now is losing value while you watch this video. Stick with me in this video and I'll give you the exact order I'd follow to start investing in 2026, starting from $0. Here's the math behind that. With everyday inflation running at roughly 2 to 3% a year, $1,000 sitting under your mattress buys noticeably less 5 years from now than it does today. And if you've actually looked at investing in 2026, it can feel like reading a foreign language. What's an ETF? What's the difference between a Roth IRA and a brokerage account? How do you place a trade without messing it up? This video is a roadmap for starting from $0. No $1,000 courses, no day trading hype. Before you put a single dollar into the market, 2 boxes need to be checked. Skip these, and you're the most likely person to panic sell later. Box 1. Pay off high-interest debt. If you're carrying credit card debt around 25% APR, paying it off is the best investment available to you. The stock market averages roughly 8 to 10% a year. Investing while carrying 25% debt is like filling a bucket that has a hole in the bottom. Box 2. Build a 3 to 6 month emergency fund. Put 3 to 6 months of essential expenses into a high-yield savings account. Life happens, a car repair, a layoff, a medical bill, and without that cushion, you'll be forced to sell investments during a downturn, locking in losses at the worst possible time. Once the checklist is clear, what do you actually buy? The most common beginner mistake is chasing hot individual stocks. Stock picking takes research, and even professional fund managers struggle to beat the market consistently. Buy Intel at its year 2000 peak and you still haven't broken even decades later. Over that same stretch, the S&P 500 has roughly quadrupled. That's why investors point beginners toward index funds and ETFs. Picture a single stock as one cup of water. If that cup spills, the company struggles or goes under, that money's gone. An index fund, like an S&P 500 ETF, is a bucket holding hundreds of cups. Apple, Microsoft, Nvidia, Tesla, and hundreds more. One company stumbles, the rest carry the weight. What to look for in an ETF? A low expense ratio, under 0.5%, ideally closer to 0.05%. And a proven broad benchmark, tickers like VOO or SPLG for the S&P 500 or QQQ for Nasdaq Tech, are common beginner starting points. In 2026, most beginners are choosing between 2 account types. A retirement account, a Roth IRA or 401k in the US, or an ISA in the UK, gives you major tax advantages. In a Roth IRA, investments grow tax-free, and withdrawals after age 59.5 are penalty-free. This is best for long-term wealth building and retirement. A taxable brokerage account gives you maximum flexibility. You can deposit and withdraw at any time with no age restrictions. This is best for flexible goals and money you might need before 59.5. Pro tip: if your employer offers a 401k match, claim it first, before anything else on this list. An employer match is free money. An instant 100% return before your investment has even grown a cent. How do you place a trade? Open and fund your account. Download a reputable brokerage app, link your bank account, and transfer your starting amount. Thanks to fractional shares, even $10 or $50 works. Search the ticker symbol. Type in your chosen ETF, for example, VOO. Choose your order type. A market order buys immediately at the current price. A limit order tells the broker, only buy if the price drops to X dollars. A recurring order, using dollar cost averaging, sets up automatic purchases on a schedule. For example, $50 on the 1st and 15th of every month. The secret to building real wealth in the market isn't timing it, it's time in it. First, dollar cost averaging. Instead of guessing at the bottom or top, commit to investing a fixed amount on a set schedule. When prices are high, your fixed deposit buys fewer shares. When prices drop, it buys more. Second, never panic sell. The market will have volatile years, drops of 10%, 15%, even 20%. You haven't actually lost anything until you click sell. Treat a market drop as index funds going on sale. Historically, the S&P 500 has recovered from every major downturn and trended upward over 20 to 30-year windows. Third, the power of compounding. Investing $250 a month starting at age 18 can grow to more than $1.5 million by retirement. Waiting just 10 years to start can cut that total by more than half. The best day to start was yesterday. The next best day is today. Here's your 2026 roadmap in one breath. Pay off high-interest debt and build a 3 to 6 month emergency fund. Open an account, a Roth IRA, or a low-cost brokerage. Pick diversified ETFs like VOO or SPLG. Automate it with recurring dollar-cost average deposits. Hold for the long term, letting compounding do the work. If this helped, leave a like and subscribe for more practical, no-hype finance content.